Let's ask Dan Greenhaus. He is Solus Alternative Asset Management's chief strategist. He's here with us at Post 9. I know you're as excited as we are about Eric Woodring coming up.
I'm happy to be here and to contribute to the show.
Okay, good stuff. So what about the momentum of the rally? Is it waning, and is that a negative sign, or is it just a rest, refresh as we round out another good quarter? We're going to be 5 months in a row up for stocks, and we just carry this momentum as we begin a new quarter.
Yeah, listen, I think you're definitely having a bit of a breather here. But in the context of what we've experienced off the October low, call it a 30% plus rally for the overall index, more obviously for a number of the names driving the gains, some level of breather. And we've talked about this, and a number of people on the show have talked about this, some breather for a period of time here into earnings season. Probably not unexpected, probably not unwarranted.
We're able to go up without tech. And that has to be viewed, I would think, as a positive sign for the overall direction.
Sure. I mean, listen, I've talked about this for a year. The industrial space continues to be a standout, both fundamentally and technically. Energy is suddenly back on the tip of everybody's tongue. A number of names in that space, something that
you've been talking about that. It's been the leading space this month.
That's right. It's been the leading space. Now, obviously, we're not. Solus isn't trading that quickly, but yes, I think there are a number of names in the energy space that fundamentally still look quite good. And obviously, the space is playing a bit of catch up here, being as under-owned as it is. But yes, you'd have to take the broadening out of the market as a positive, all else equal.
So we did our Delivering Alpha investor survey where we asked many of the folks who end up coming on the network and talking about the markets. Do you think the market has run too far too fast? Almost 2/3 said yes, we're in for a pullback. What do you make of that?
Well, I didn't contribute to that survey.
Well, how would you would have?
Folks, nobody told me about it. What I've said, listen, we've talked about this in the past over the years. I struggle with the phrase "too far, too fast." I don't know what that means. No one has ever really defined that. Do I think that a point like Joe Terranova has made in the past, is the index too far away from its 200-day moving average? Probably. And some level of at least a pause is probably worthy. So if that's your barometer for quote-unquote too far, too fast, yeah, it's probably gone too far, too fast. But again, that doesn't mean that you need to have some 15% decline in equities in order to restore equilibrium. It just means you can't keep going up at the pace that we've been going up, and there's nothing particularly difficult or unusual about that.
Have we gone up the way we have? If you think, yes, maybe it's too far, too fast, is that because of pending rate cuts? Because, again, in the same survey, when you ask, how many times is the Fed going to cut rates in 2024, 2 is almost 2/3 of the vote. So the market thinks 3. The Fed dots suggests 3. Our smart investors and market watchers think, no, more likely 2.
Yeah, I thought for a while that 2 was probably your over-under, maybe 3, but let's call it 2.5 was your over-under. The market was always, the Fed Fund futures pricing was always incorrect. I'm not even really sure how to explain to viewers why that is, other than to say 6 or 7 rate cuts was almost never going to happen unless you had some sort of meaningful drop-off in economic activity, the likes of which I and numerous other people did not expect. So your over-under is, call it 2 for the year, maybe 1 in the summer, and maybe they sneak 1 more in before the election or shortly thereafter. But do I think that matters? No, I don't think that really matters per se. And you've seen this 30% rally we've had off the lows has come as we've scaled back those expectations, as longer-term and medium-term Treasury yields have backed up. You've still had both a broadening out in the market and a perpetual move higher, both of which are positive and are independent, really, of what the Fed is likely to do.